everyone, and welcome to another episode of Get Social with Bond Finance. My name is Sarah Wilkins, and I'm sat here today with my co-host, Bruce Mannering, Director of Bond Finance. Hi, Bruce.
Hi, Sarah. How are you?
I'm good. How are you?
Very good indeed. Very good indeed. Thank you for doing
Good,
this today.
good. So today we are going to be chatting about bridging.
Yeah, exactly. Because I get lots of questions about bridging, and I think the best way to people to understand bridging is via education. Hence these podcasts. So today is about bridging. So let's start off with who Bond are. Well, I started Bond back in 2004 with my business partner Dan Newbury. We're FCA regulated and founding members of the NACFB. All our brokers are CMAT qualified, and we've got two departments. We've got a residential and buy-to-let department, and we've got a commercial department. The commercial department basically does bridging, refurb finance, development finance, funds at office blocks, industrial parks, basically everything which the other department doesn't do. This is the merry band of men and ladies in the office. We're a medium-sized firm based at 50 Gresham Street, next door to the Bank of England. So, when do you use bridging or short-term loans? Well, these are the four most common reasons. There are other reasons why you would do it. So, if you're looking to refurb a property, you're looking to extend a property, you're changing the use or planning of a property and then doing works, or you're just building out the property using PD rights. So, and all these scenarios you would use short-term products, i.e. bridging. And there's many products in the market. When I started 20 years ago, there was probably only about 4 or 5 bridges. There must be at least 100 now. And they're all offering the same sort of products out there. But it's the nuances between the two. Do they do an open market value, or do they do a 180-day value? We covered that off in our previous podcast, didn't we, Sarah?
We did indeed. So if you haven't seen it, make sure you go and have a look.
Yeah, go and have a look at that and read and gloss up on open market values and 180-day values, because it makes a big difference, especially if you're borrowing large sums of money. So residential rates are generally between 0.65% and 1.1% per month. It's not per annum. All bridging is expressed per month. So you need to annualize it to work out the true percentage. And it all depends on the loan size, the purpose of the bridge, and also the loan to value. We can now, in some cases, get up to 85% loan to value on a bridge. The best rates are down at 55% because there's virtually no risk for the lender, but we can go up to 85%.
Okay.
And you get bridging on residential properties, commercial properties, semi-commercial properties. And generally the pricing for commercial and semi-commercial is generally higher, and the loan to value is lower because of the perceived higher risk profile for semi-commercial and commercial property. What is semi-commercial property? Well, semi-commercial is generally when you've got a shop below and flats above. That's classed as semi-commercial. You've got mixed use. You've got a commercial element and a residential element. And because of the residential element, it's classed as a lower risk profile than if it was 100% commercial. So you get better rates. So the semi-commercial rates are in between the commercial and the residential rates. Generally, the valuations are based on 180-day in 90% of the market. There are some lenders who will do open market values like Glenhawk, Signature, Shawbrook. They will do open market valuations, but majority will do 180, which is the value of the property if it's going to be sold within 6 months. Now, you can also have 2 different options when applying for a bridge. You have the interest serviced on a monthly basis. So you pay the interest on that loan like a normal mortgage.
Yeah.
But normally a bridger deducts 12 months worth of interest up front. And as soon as you pay that money back, should we say you pay it back in month 6, you get 6 months back credited to you. Okay?
Yeah.
If you use the full term, you get no money back.
Yeah.
Okay? So let's look at the difference between the two, serviced and deducted. So this is interest deducted, where we got a security of £1 million, nice round figure, 70% loan to value, interest rate 0.95. The arrangement fee is 2%, and that's been deducted off the loan. Then 12 months worth of interest is deducted from the gross loan, from the 700. And the net effect of all that is that even though you're borrowing 700, that your net loan is 605,000 down here. Okay?
Yeah.
So that's quite a big difference. That's a 10% difference between
It's a bit of a chunk, isn't it?
Yeah, bit of a chunk of wedge. Now, same loan, different lender. Okay? Still going for £1 million value, still borrowing 70% loan to value, but the net loan is 697. So they're basically £95,000 better off day one, and they're servicing the interest on a monthly basis. They get more money up front. Also, Shawbrook adds its fees while other lenders deduct their fees. So the Shawbrook actually add their 2%, so the loan is 77%, while other lenders deduct their fees, where it's 68%.
Yeah.
So that's a big difference, especially if you're short of money, but you can prove that you got good income to support a loan. It means you can look at the serviced options in some instances. Now, what happens if you want to borrow money for the build cost? You've got a big project, shall we say, purchase price 400,000, the build costs are 100,000, and the NGDV is, I don't know, 750,000. Okay. Now you can, with that sort of size build, it's now actually worth potentially looking at the development lenders, which will actually fund up to 100% of the build costs.
So we're right up to 100%, sure.
Yeah, subject to 65% loan to GDV. So the loan's in two parts. You've got your first part to buy the building, and then you've got your second part to fund the build. Those two parts can't be more than 65% loan to GDV. And so on my scenario, so if the end GDV is £1 million, the total debt can't be more than 65% of that, which is 650,000. Okay. So they'll Mint, for instance, in this example, will lend 75% of the purchase price. The interest can be serviced or deducted. It's a 180-day vow, and there's no exit fee. And then they'll lend you up to 100% of the bill cost funded in arrears. So if your bill cost is 100,000, you'll probably break that down into 3 or 5 little sections. So chunks of money between 25 and 35,000 pounds. And you would spend that money first, then a QS will come round, sign off the works, and then send you the money for the work which you've completed. And then with that money, you then get the next stage done. Then he comes around again and then does the next stage.
Done in tranches.
And in tranches. Now, you don't want too many tranches. The reason why is he charges fees for it. Every time he comes round, he'll charge you £700 to £900 just to write up a report.
Yeah,
so you've got the initial QS report, which will probably cost a couple of thousand, and then you've got all these tranches. So you should only really borrow development finance or borrow for the build costs if the build is big enough to warrant it and there's a big enough NGDV. If there isn't, look at other ways of funding it. Okay, because all these admin costs eat into your profit margins.
Can I ask a
Okay.
question? If there's like, let's say, for example, you're trying to minimize these visits, is it a good idea to possibly send progress updates or progress updates? Does that help at all, or?
With some lenders, they will lend off like Aspen. Aspen will, if it's a light refurb, they'll go off pictures and receipts.
Yeah.
Okay.
Okay, well, that's
If
good to
it's a,
know.
if it's a bigger build where you're putting RSJ joints in,
Yeah.
they wanna keep an eye that you actually you know what you're doing, or you're
So
moving
from
chimney.
especially from a structural point.
Yeah, from a structural point. So the QS is going around to sign off the works, but he's also looking at the quality of the works and has the work been done properly.
Okay. Yeah.
Yeah,
Yeah,
but he
makes
will
sense.
report back to the lender if he thinks bit shoddy on this.
Mm, okay.
Okay,
Fair enough.
well, cool. So so yeah, that's an example of a lender lending towards the build cost. Now let's look at a case study. So this is in southeast London. It's a three-story building. There it is. Southeast, and they got PD to convert into 4 flats. Lots of people are doing this, looking at converting commercial to residential.
Yeah.
Because you generally get a big uplift because commercials lower value and residentials are higher value. So this scenario, PD was in with the conversion had been done under PD, purchase price 750, build cost 300, NGDV 1.55 million, post works rental 48, not great, but it's but it's still 30% profit on costs, and that's what you want to be looking at. You want to be looking at minimum 30% profit on costs,
Oh, okay.
because of all these fees, fees, interest, fees everywhere. So you to make any sort of profit, you need a good deal. You need a
Okay.
good deal.
Yeah.
So we went to Octane on this one. Gross loan of 934. The bill cost was 300. They actually gave him a facility of 341
Okay.
because they added 10% onto the bill cost for contingency, and then the interest on that money is the rest of that 341. Okay. The gross loan day one was 525. There was a 2% arrangement fee charge, our 1% broker fee. We like Octane because at the time they had a very small admin fee of 995 for all the visits. So instead of
Okay.
other lenders charging £3,000-4,000, that was just a one-off fee with Octane, which is I like that.
Oh wow, that's great, Sure. Yeah.
Yeah, saves money. And
Mm.
the important thing, we worked with the client to produce a valuation pack for the NGDV. So we got a schedule of works from the client. We got before and after floor plans. We got them to put together a mood board,
Yeah, I
color
love it.
palettes and all fluffy stuff.
Love
Uh,
that.
and put it together with a valuation pack. And we got that over to the valuer prior to him even looking at the property,
Yeah,
so
that's
that
great.
he can start thinking about, okay, is that NGDV there or thereabouts? So just making him think about things.
Yeah.
Project completed in 7 months, and as it was only 4 flats, we ended up going to Kent Reliance on the exit on this one.
Oh,
Just a simple buy-to-let lender
yeah.
on a product, multi-unit building product. They lent 75%. The value actually came down a little bit. We got an NGDV at 155 with Octane, but Connells, who Kent Reliance use, valued at 1475. So 75 grand short. But the loan was still 1125, and the client was happy with that because he realised he was just recycling all his money back out so he can go again.
This is
And
amazing.
he's got 4 flats. and he's got all his money back out.
I
And
mean,
more than happy with that. More than
that's
happy.
what it's all about, right?
Exactly. Exactly. So if anybody's got any projects they want me to look at or comment on, please feel free to reach out, and I'm more than happy to help.
I can vouch for Bruce on this. We've done a lot of projects with Bruce and used bridging before as well. And just touch and base on what you said earlier on about doing the valuation pack and things like that. I think sometimes where people go it alone, they don't really know that, to do things like that. So always use a broker, always use a good broker, always use Bruce Mannering from Bond Finance.
Thank you very much, Sarah.
Bruce, another fab episode, and I will see you next time.
Sounds great. All right. Thank you,
Bye.
Sarah. All right. Toodaloo. Cheers.